momentum does continue. We see some new highs across the indices, both NASDAQ and the Russell up 6% and 15% respectively. And we really kind of have a Goldilocks scenario, if you will, right now.
It does really feel like that. And I honestly don't oftentimes like using Goldilocks just because I really enjoy children's stories, and the Goldilocks and the Three Bears. If you think about it, Goldilocks, she was a criminal, right? Breaking and entering. She steals their porridge, sleeps in their beds and that. And so maybe this is a baby bear kind of scenario where it's just right, because it's not too hot, not too cold. We do have these new highs. And one of the things that I think oftentimes happens when I read through the financial press is everybody lamenting about, this is such a narrow rally. But it's really not. It has broadened. And I think a lot of people just haven't really been paying close enough attention to how it's small caps, it's different industries. They're beginning to participate.
And in Goldilocks, as the criminal, is certainly going to get all the attention. But that's exactly right. It's not just the Magnificent Seven. And by the way, it's probably just the Magnificent Six anyways, because you have to take Tesla out of that at this point. But it has expanded. You look at across different sectors, and you look across internationally as well, and it's starting to expand.
Yeah, emerging markets have done quite well, and even Europe is beginning to turn a corner. Some valuation opportunities there, perhaps because they have been a little late to the game. And on our investment committee, when we're looking at the opportunities, obviously we want to understand the fundamentals. And one of the biggest fundamentals that you can pay attention to are the earnings. When we look at the S&P 500, it hits a new high, but guess what? So have the earnings. And so even though you can easily argue that, well, maybe things have moved a little bit too fast, maybe too far, maybe not, especially since earnings, we did have that earnings recession back in 2022 and also part of 2023. They're beginning to stage that recovery. Now, will this continue? That is a good thing to kind of think about. We believe that the fundamentals are still there to support corporate earnings marching higher.
So the S&P up 8% on earnings in 2023, expected to be 14% in 2024. That is room for debate, but when the analysts start to improve their earnings, that's usually a good thing. And by the way, the comparisons from last year are going to be pretty easy, so that is good for the market as well.
That's correct, because the real trough for earnings when we had a little bit of an earnings recession was in the first part of 2023. And so now that we're in the first part of 2024, those year-on-year comparisons are going to look a lot more favorable. One thing I would point out is that while the S&P 500 and the NASDAQ have hit these new highs, the Russell 2000, so the small guys, they are still about 14 to 15% below the November 2021 peak. And part of it is they've had a little bit more challenging environment in terms of the earnings recession. It was a bit of a double dip earnings recession for them. If we get a little bit of stability with the interest rate environment, maybe we're there. That could go a long ways towards maybe improving sentiment towards some of those smaller and mid-cap names.
And there's no question, though, that the folks could be subject to some type of risk if they are overweighted in just a number of those companies. We call it concentration risk.
That's right. Yeah, concentration risk is something that people should really focus on, just to kind of do a little play on words there, right? You should concentrate on your concentration risk, mainly because if it goes up, that's fantastic. But do you really want to put all of your eggs in one basket? Andrew Carnegie, the great industrial magnate, he once said that put all your eggs in one basket and never take your eyes off that basket. Maybe that worked for him, but that generally speaking doesn't work all that well, because if everything is all on one particular company or one particular idea, what happens if that doesn't play out? And that's why we always preach the virtues of diversification.
In a balanced portfolio. So let's switch gears just a minute. Speaking of a balance, right now the Federal Reserve certainly had indicated early on, at least last year, that they were going to lower rates, and that doesn't look like that's going to happen here in March, probably kicking that can to June that you and I have talked about before. And the market had expected 6 rate cuts. That certainly doesn't look like that's going to happen. So look for June, a rate cut in June, and we'll have to see what happens with their meeting next week.
That's right. Next week, we get the monetary policy report of the government. That was released on Friday. It's great bedtime reading. If you have a difficult time falling asleep, crack that open. But it was actually really interesting. So Chair Powell will be testifying before Congress on Wednesday and Thursday to give an update about what's going on with monetary policy and the economic environment in general. And just to highlight the efficiency of our government, he delivers the same speech on Wednesday as he does on Thursday because, he has to deliver to the House and then to the Senate. But it does really sound like all of these Fed officials who have stepped out are preaching about patience. We can be patient. If it ain't broke, don't fix it, right? We have a low unemployment rate. Incomes are still rising. Inflation, it is above their target, but trending lower. They probably think that they can err on the side of waiting to cut as opposed to feeling like they need to cut anytime soon.
And maybe their focus moves away from this PCE indicator, this one of their preferred measures of inflation, to more employment and unemployment. And that is really the reason why we're starting to see some of this inflation become sticky, because people are employed, therefore they go out and spend. As they spend, they're keeping prices up. So we're going to have to see if there will be some type of washout in the unemployment market. Lastly, obviously, it's a presidential election year, and the market does do well in those environments.
Yeah, this is the time of year, seasonality-wise, where you can get some choppiness when you are in the February-March period. But people are really beginning to anticipate who is going to be in the White House, what the composition of Congress will be, and then as Todd Voigt, our chief investment strategist, always says, when there's an election, there's this date with destiny. You know when it's going to be resolved. And really, for the most part, when that uncertainty is resolved, it oftentimes, more often than not, is beneficial for the overall markets.
And we'll have to see if we really do know that in November,
That's true.
or if it becomes something that the Supreme Court has to weigh into.